When Donald Trump talks about trade, the world listens and trembles. But this time, his new trade tension isn't with China or Europe. It's with Brazil, one of America's biggest partners in the Americas. What's really happening, and how could this reshape global markets? Donald Trump's renewed push for America First policies has triggered fresh economic friction, this time with Brazil. What began as a friendly trade relationship is now clouded by disputes over agriculture, steel, and currency policy. Trump's team accuses Brazil of gaining unfair trade advantages, pointing to Brazil's currency depreciation and cheap exports that threaten U.S. farmers and manufacturers. In response, Trump has hinted at possible tariffs or restrictions on Brazilian imports, a move that could disrupt billions in annual trade between the two nations. Brazil isn't just another trading partner. It's Latin America's largest economy and a vital supplier of soybeans, beef, iron ore, and steel to the U.S. On the other hand, American tech, machinery, and energy firms rely heavily on access to Brazil's massive consumer market. U.S. farmers could face higher costs and fewer export opportunities. Brazilian exporters could lose access to a critical market, and global investors might pull back from both economies, fearing instability. In short, a trade war between these two could send shockwaves through commodity markets and Latin American currencies. Political analysts say Trump's approach follows his well-known pattern: apply pressure first, negotiate later. His administration has used similar tactics with China, Canada, and even the European Union, pushing for better trade terms through aggressive rhetoric. The logic? Create uncertainty, then demand concessions. In Brazil's case, the pressure may be aimed at winning better terms for U.S. agriculture and energy exports, or at influencing Brazil's monetary policy, which Washington claims keeps the real, Brazil's currency, artificially weak. Brazil's government has so far responded cautiously, calling for dialogue and mutual respect. However, behind the scenes, officials are reportedly exploring diversification of trade routes, especially toward China and the European Union, in case the U.S. market becomes less reliable. That could signal a long-term shift in Latin America's economic alignment, something Washington wants to avoid. If tensions escalate, expect ripple effects across global markets. Commodity prices could spike, especially soybeans and iron ore. Currency markets may see volatility, as the Brazilian real and U.S. dollar react to trade news. Emerging markets could suffer capital outflows as investors seek safety, but if Trump succeeds in forcing a renegotiation on favorable terms, it could temporarily strengthen the dollar and boost U.S. exports, though at the cost of diplomatic strain. This conflict isn't just about tariffs or soybeans, it's about economic influence in the Western Hemisphere. Trump's administration wants to ensure that Latin America stays within Washington's economic orbit, rather than moving closer to Beijing. Brazil, however, is trying to balance both sides, securing Chinese investment while keeping U.S. trade open. The outcome of this tension will define not only U.S.-Brazil relations, but also the future of trade politics in the Americas. This isn't simply a trade story. It's a power struggle playing out on the world's biggest economic stage. If Trump's tactics succeed, the U.S. could regain leverage in Latin America. But if Brazil resists and pivots toward China, it might mark a historic shift, one that could reshape the balance of global trade for years to come.